love to get a bit of background on influences with how you started investing. And I heard a story about your early days on the dealing desk at Perpetual, which was in the lead up to the tech wreck.
Yes.
And you were working under Peter Morgan, who's one of Perpetual's well-regarded head of equities. Could you share a few of your experiences and memories from that time in markets and what it was like being an investor at that time?
Well, back then, it was quite a tough period for value investing in Perpetual at the time. So given that we have a very conservative investment process and philosophy, we were underperforming the market quite a lot. There were a lot of hot stocks that we didn't own. News Corp, I remember, was I think the largest stock in the index at the time, and one of the best performers, and we held no shares whatsoever. It was very, very tough time for value investors. Just a lot of what we saw back then in terms of investor psychology and investor behaviour, we're seeing signs of that today, actually. So, and what I mean by that is investors are very focused at the moment on what can go right. What's the upside? Focused on returns, not really focused on the risk that they're actually taking. So, investing is about risk and reward. And what we're seeing, a lot of people are focusing on the reward side of the equation and not actually taking account properly, we feel, of the risks that are in the market at the moment.
Peter would have been a mentor of yours. What sort of things was he saying to the investment team? How was he handling? Can you recall the sorts of things that he was saying at that point in time?
Yeah, well, the investment process and philosophy, it's very rigid around, ensuring we've got a very strong buy-sell discipline around valuation. So valuation is really key. And at the time, there were a lot of stocks that were trading at valuations that we felt were not justified. And so, from our point of view, we just kept on doing what we always did, and that was try and identify quality companies that were representing value. And at times it's absolute value, and times it's relative value. And I think back then it was about identifying relative value, good solid companies, had strong balance sheets, decent management teams, could pay dividends through the cycle. And that's what we really focused on. And even today, we're underperforming as well, but that's where our focus is. We're not focusing on the things that we can't participate in or the hot sectors where we feel that valuations are too rich and aren't justified.
So those things, balance sheet, management, valuation, they're the non-negotiables for you?
Yeah, definitely. The quality of the business is a non-negotiable. You don't want to compromise on the quality of the business. Valuation, really key. We believe that the price that you pay for an asset is very, very important, especially around your future returns and expected returns. So paying the right price is very important. And also the other thing that we think is also very important is balance sheet. And the reason why is, when the business cycle changes, a company with a strong balance sheet has optionality. They can continue to pay dividends through the cycle. They can take advantage of opportunities within their industries. And so we think that gives you or affords a company a lot of flexibility, but also as an investor, it keeps you out of a lot of trouble as well.
In the recent presentation that you gave to advisors and the team gave to advisors, you talked about the decade post GFC being effectively a tale of two halves, 2 5-year periods.
Correct.
The first 5 years, the Perpetual strategy and value actually performed quite well.
Correct.
The second 5 years, it's been hard to keep pace with the market. What is it that worked during the GFC? What helped coming out of GFC, and why was it good for returns?
I think coming out of the GFC, our focus on companies with strong balance sheets was really important. It helped us come out a lot sooner. The companies that we held were still paying dividends. They didn't have to worry about recapitalising themselves or their capital structure. They had good balance sheets. They could take advantage of opportunities or competitors that were weak. But also value was in abundance back then. So that 5-year period coming out of the GFC, we performed extremely well. And then the start of QE3, the next 5-year period, when interest rates were starting to fall, and at the moment they're artificially low, but they're low, and a lot of people say will be low for a long time. We've found that we've struggled to keep up. value as a value manager, what we're struggling with is a lot of companies, or a lot of investors are increasingly paying higher and higher multiples for the same earnings stream and justifying it in all sorts of and manners. And for us, that's an environment where when you have valuations that are elevated, we tend to underperform.
Yeah. No one, you might be able to, you can explain why that underperformance exists. No one really enjoys it. And if the low rate environment has contributed to that, does the recent change in stance from the RBA, or the renewed stance from the RBA, and potential change of stance from the Reserve Bank, does that prolonging of the low interest rate environment, does it concern you?
Yeah, it doesn't help if you're a value investor, that's for sure. Also, our investment process and philosophy, we focus on the balance sheet, as I said. So a lot of where we haven't participated in the rally is, for instance, infrastructure. A lot of infrastructure stocks have capital structures, too much leverage on the balance sheet. So typically they don't even make our quality universe. Now you look at, as interest rates have started to fall and have continued to go lower, they've been some of the best performing stocks, and we haven't participated in any of that. So it is challenging from our point of view. But what I would say on the flip side is there's a lot of high quality industrial companies today that are actually giving you, they have decent balance sheets, giving you a decent yield that's fully franked. Yeah. And the market's almost forgot about those opportunities.
I'm going to move on from the value investing discussion in a second, but what do you say to people that come to you with question marks about the viability of value as a style? You would have had advisors wanting to know from you.
Yes.
It's a common question in the market. What's your sort of short response to that?
Well, I think in all of us, we're all an investor to some extent. Yeah, and everyone, I believe, is concerned about what price they pay for an asset. I don't see anyone just to, if you're buying a house and the real estate agent says, well, we want 5 million, you don't turn up and just say, well, I'll pay 5 million. Typically, people want to ensure that they're getting or buying an asset at the right price, at the best price. So when you think about it in that view, is value investing dead? Absolutely not. Because we're all concerned about the price we pay, and we all want to be paying the right price. Having said that more broadly, what does it actually mean where we are today? I think value investing is cyclical. And if you have a look over a long period of time in history, value investing has outperformed growth. It's been this last 10-year period where interest rates have been historically low, where it's been a long cycle of underperformance for value. But that's in a 100-year period, it's been the longest period of underperformance for value. So I would say it's cyclical. I would say low interest rates definitely have contributed to some of that. But also the rise of passive investing, I think it also plays a part in making value investing, making it a bit tough at the moment, because passive investing is about buying the winners. And as money continues to flow into passive investing, you're seeing these winners, and passive investing is value agnostic. They just buy what's the biggest in the index. And so that also makes it quite challenging for value investors today. But again, as I said, it's not broken, it's definitely cyclical.
On the cycle, what do you and your team look at to get a sense of where we might be in the cycle? We talked about it being a bit prolonged. What are some of the things and the markers that you guys can look at to give you a sense of where we might be? Well,
valuations relative to history is a key one, obviously. But a lot of investors will tell you, well, interest rates are low, so valuations are justified at being really high. And there's some validity to that argument. But having said that, investors are forgetting about the other side of the picture, which is earnings. What are earnings doing? Well, if you have a look globally, and also in Australia, earnings growth is starting to tail off. So when you put it together, we're definitely late in the cycle. So we've got really low interest rates. We've got a lot of leverage in the system, and corporates are highly geared, but also households. Valuations are quite high. We would say you're very late in the cycle, and we're seeing behaviours, investor behaviours in particular, that are starting to concern us. So there is a bit of a fear of missing out. Investor psychology, as I mentioned before, is all about what can go right and not really fully assessing the risks to the downside. So we're definitely late in the cycle.
In terms of the companies and the stocks that you're not owning, and the exclusions, you touched on infrastructure there. And if we think about things where you feel like there's a big risk to the downside, what are some examples of some of the sorts of areas of the Aussie market that you're really avoiding and that give you concern?
Well, infrastructure, because of our process. Also, within our process, we don't invest in stocks that haven't turned a profit. So a lot of the high-flying, tech stocks that are yet to make a profit and have big valuations, we're not participating in those. Now, not all of those stocks are going to be around in 5 or 10 years' time. There will be some that will justify their current valuations and grow into their valuations, but there will be some that won't be around. So from our point of view, a lot of those techie style sectors, we're not really participated in at all. And that's part of our conservative investment process and philosophy that steers us clear from those hot sectors, if you like.
Yeah. There is this perception that the blue chip market in Australia is a bit tired and boring, particularly when you put it against some of those racier names that are in that tech sector. But Telstra, which is about as tired and boring as they come, is up 40% year to date. Are there some examples of some companies at the big end of town that you think are being overlooked and have some quality attributes and value attributes that sort of jump off the screen at you?
Yeah, that's a good question. Boring is actually good. As investors for us, we actually quite like boring companies that just go about their business and deliver dividends for shareholders and have a good management team that run it. But one stock that does stand out for us, and we think the market's overlooked for a macro reason, is Medibank. Medibank is one of the largest health insurers in Australia. The perception from the market is that, and it is correct at this point in time, is that the private health insurance industry is shrinking. So we're losing policyholders, or policyholders are downgrading their cover because of affordability concerns. But why do we like Medibank? Well, for the first time in a long time, their core Medibank brand has started to grow policyholders, which is very, very good. They're on top of a lot of their previous issues around customer complaints. They've invested heavily in their digital part of their business and are engaging much, much better and much better than all their peers on the digital front. It's a high ROE business. It's got a 21% ROE. It's got a net cash balance sheet. It has the ability to increase its dividend payout ratio, and it has excess capital. And this is all on a market multiple. But the market has overlooked this because of the macro concern around policyholders shrinking. Now, we believe that Medibank is best in class. They're outperforming their peers and their competitors with a lot of their initiatives around cost, around getting claims costs down, and they're well ahead of the industry. And we think they will continue to be an industry winner, even in an environment where the industry shrinks. So that's one where we really like. Since the election, it has had a bit of a pop, because the coalition government is perceived to be better for private health insurance than the Labor government. But we still think that that's a high quality business, totally overlooked by the market.
Woolworths is a stock that, as a firm, you were backing, even having a look back, I think 2015, 2016, around the time that Brad Banducci got involved.
Yes, that's right.
And it was an unpopular stock. The story has worked out really well to the extent that I understand you've been lightening your position.
Correct.
In Woolworths. Just keen to understand if the environment for retail, for the supermarket, has there something changed in the environment for them, or is it purely a valuation piece? Just interested to understand how that thesis has changed for you.
It's predominantly around valuation. So it's approaching what we think is a fair value for the business. And so that would be the first point. Having said that, the environment for grocery retail is still pretty good. So we're in a very rational environment at the moment. We haven't seen food price or grocery price inflation for a while, and we still think that could start coming back. So that's a bit of a tailwind. Amazon has launched to much fanfare, but has been a bit of a flop. Now, You can't get complacent about Amazon. They will be back and they will compete. But the structure of the market, grocery retail in Australia, is a much better structure than you'll see anywhere else in the world. But predominantly it's valuation for us.
Yeah. The Royal Commission was a really big thing particularly for the banks here in Australia, and I think a lot of people would justifiably feel let down by some of the things that came out of the Royal Commission. With that now complete, do you see a better pathway forward for these big institutions that are important for a lot of investors and a lot of Australians?
Yeah, it's a good question. Well, look, it can't get worse for them. So incrementally, the negative news flow has gone away. So, and as you've seen since the end of the Royal Commission, there's been a few tailwinds for the banks. I think the biggest thing for the banks and their earnings outlook that you need to focus on is, and we've seen a bit of a relief rally in the banks, what you need to focus on is interest rates. Interest rates going down or being cut is actually not good for earnings because that really pressures their net interest margin, and that's where all the leverage is on the earnings front. The fact that interest rates are lower probably means that bad and doubtful debt charges aren't an issue, and also probably takes out the downside scenario for the economy. Yeah. So on the whole, they've probably re-rated to a point where they're probably fair value, but I would look at the NIM. That's really your guide to the earnings outlook.
I'm going to bring us back to the roadshow presentation, and one of the comments that you talked about was the team's desire to deliver better returns for your investors. The perpetual philosophy sounds like it's pretty set in stone and something that you return to. So if you've been executing the perpetual philosophy, what do you do? What can you do differently to change the outcome? Yeah,
that's a good question. Well, we're not changing the way we invest. That's number one. So I think one of the reasons clients give us their money is they know what we are, and we're very true to labels. So, you know, we focus on quality and value, but value being the key, and I think that's important. So people know what they're getting with us, and as it stands today, we haven't done, we're lagging the market. It's disappointing. We all want to be doing better as a team, obviously. A lot of our team members are invested in the funds alongside our clients, so we are aligned with them. What can we do if we're not changing our investment process or philosophy? Well, what we're starting to do more of internally is we've been investing in our research capability internally. So even though it's been a tough time for value investing, we've grown the team and our resources and our capability, and we're looking to do more proprietary research in-house. And we think that will give us proprietary insights or an edge relative to our peers. And so we're investing in our own research in-house capability that we think will provide benefits in the medium to long term for our clients, because we will be able to use those insights to better inform our investment decisions.
Final question, and this is one that I ask everyone that I sit down with that's been investing for a while. We all make mistakes along the way. Hopefully we make mistakes that make us better investors. Yes. Can you draw on a personal experience, something that hurt, something that stung, that sits with you today that makes you a better investor?
Well, I can't recall a company, but where I tend to make, and I make the same mistake, but it's always a different company. And you compromise the quality of the business, so you go because of the price, and you get stuck. So being a value investor, the one thing you have to avoid is value traps. And typically as a value investor, you always get lured to the price of something. You go, well, that looks interesting. And then you make an assessment of the quality of the business. And typically what you do is you overestimate the quality of the business, and that's where you end up making a big mistake. And I've done that on a number of occasions and always think that I learned my lesson for next time, but find that it manifests in a different opportunity, and sometimes you get the same outcome. So that's the biggest mistake. So compromising, I think, on the quality of the business that you're buying because the price is attractive.
Great. Well, Paul, thank you for taking a bit of time out of a busy day to have a chat with us today. I've really appreciated it.
Thank you.